All right. If everyone wants to take a seat, we're going to start this special session on private equity. And there will be 3 presentations. So Stefano is not here, so it will be 3 presentations of about half an hour. Feel free to send questions. As far as I understood, there is like an app system where we will see your questions showing up somehow. So we look forward to that. We're going to start with Karin here, and then Eddie, and then I'll present the last paper.
Okay. So maybe I could get my presentation up. So thanks anyway for inviting me here and for having me on the panel. I'm very excited to be here and discuss private equity with you. So the paper that I'm going to present is the first time I'm presenting, actually. So you have to forgive me if I stumble a little bit, but I'm also very interested in hearing your comments on the work we're doing. The working title is Skin in the Game, Wealth and Risk-Taking Evidence from Private Equity Funds. And this is joint work with my colleague at the Norwegian School of Economics, Karsten Beens, and Uwe Waltz, who is in Frankfurt. The motivation behind this paper has to do with the compensation contracts. I mean, both more generally, but in particular in the private equity setting. You know, the compensation, we generally think about that as being designed to align the interest of managers and investors. And most compensation contracts have a structure that option-like. There is some fixed pay, that could be fixed compensation for a CEO, or it could be the fixed management fee in the private equity setting. And then there is some upside. For CEOs, it's commonly some equity-based compensation. It used to be options. There can be other type of incentive plans or bonuses. In private equity, we have the carry. I mean, a typical private equity contract, as I'm sure most of you know, is the 2% fixed fee plus or management fee plus the 20% upside carry. But we also know that option-like contracts, their value increases in the volatility of the underlying assets. So there's a concern that options are going to induce the incentives to risk shift or take on suboptimally high risk level. There is some work in a corporate setting showing that it seems that managers receiving option awards actually increase the risk of the corporation through their investment policy and through their hedging policies. In private equity, you obviously have the same concern. Could or would managers, here the general partners who manage the PE funds, increase the risk of the underlying investments too much? So the way that's been dealt with in private equity is that limited partners, who are the investors, ask the managers, the general partners, to co-invest with their own money in the fund, and this gives them a claim that's basically an equity claim, and that's what we call skin in the game. So what we're going to address in this paper is whether such skin in the game reduce the risk-taking of general partners. Of course, we cannot address if it reduces this too much or not. We are just going to see if there's any evidence that it actually works this way. So we focus on 2 dimensions of risk. One is project risk, and there we're thinking about the risk of the underlying portfolio company, so the investment choice of the manager, and the other one is the financing decision, how much leverage do managers put on these portfolio companies. And what's a novel contribution of this paper is that we're able to observe managers' individual wealth. And of course, we all know from theory that the wealthier you are, supposedly the less risk-averse you are. So accounting or controlling for wealth could be very important in looking at the incentive effect of requiring a co-investment. There is always a concern, of course, that the co-investment fraction, which is fund-specific, is set taking into account managers' wealth levels. However, what we do observe is that at the time when the fund is raised, wealth doesn't explain the co-investment, but then wealth changes over time, and we're also going to observe how it then influences the manager's risk-taking pattern over time. So we develop a simple model of the GP's investment decision, and then we're going to take the predictions of this model to the data. We're using a sample of Norwegian PE investments because we can observe the wealth of the Norwegian partners. And again, the Norwegian setting allows us to exploit this wealth data, which is quite unique, I would say, for the Nordic countries, that you have the access to that type of information. So I'll just give you a quick sense of the model. I'm not going to go too much into model detail. And again, I would say it's a relatively simple model, but where we then model a project choice that is combined with the capital structure decision. So there is a PE manager, the general partner, who invests I, choosing a firm from a menu of firms with different risk. And to capture risk, we've modeled that there are 3 different outcomes. There is a medium state returning R, a high state returning R plus delta, and a low state returning R minus rho. And delta is greater than rho, so it's a positive NPV project. And the probabilities are half a Q for the tail outcomes and 1 minus Q for the medium outcome. So you can immediately see that Q is our measure for risk. The higher the Q, the more weight you're going to have on the tail outcomes, and therefore the riskier is the project going to be. And the higher is the NPV going to be as well. So firm value is increasing in risk because of this, that it's not this asymmetric payoff. And the manager can then decide to finance this investment I with debt in a competitive loan market, so there are no margins captured by banks, and the rest I minus D from the PE fund. And we consider debt levels that lead to default in the bad state only. The firm will never default in the medium and the high state. And we also introduce a reputational loss for the general partner. So there is a personal cost for the partner of having failed investments. In our model, the general partner is risk averse. The other players aren't. The bank aren't. Investors aren't. And again, this risk aversion means that the general partner is facing costs of higher risk, and they are increasing. And these costs are increasing in Q, our risk measure, but decreasing in wealth, so wealthier managers, less risk averse. And there are 2 elements of the GP's compensations that's of interest. It's the carry and it's the co-investment. We show in the model that a fixed management fee doesn't affect incentives. I mean, it could potentially, if you take into consideration the possibility of raising a new fund, but that's not in our simple setting. So the carried interest is simply a fraction above a hurdle rate that the GP will participate proportionally in the upside. And the GP will receive a carry in the medium and the high state. And the co-investment beta then allows the GP to participate proportional both in the upside and the downside. So that's really creates this skin in the game. And as I mentioned before, the general partner trades off 2 types of risk. There is the project risk, where a higher Q leads to higher expected return, but then more bankruptcy risk as well, which is costly for the manager. And then you have the leverage, where the higher leverage leads to a higher expected carry, because it's more gearing. I mean, simply expected returns are higher, but then also greater expected costs of bankruptcy. So running through this model, which we do in the paper and which I'm not going to show you here, it turns out that the 2 risks operate in different directions. So a manager with a higher co-investment, here beta, then choose less risky projects, but then because these risky projects have more debt capacity, also choose to hire with more leverage. That's what the model predicts. And a higher wealth will then reduce risk aversion and therefore mitigate these 2 effects. So higher wealth means then, compared to the zero wealth states, means slightly higher project risk and then slightly lower leverage, so mitigates these 2 forces. So the prediction, if I combine the wealth and the co-investment effect, means that higher relative or wealth-adjusted general partner co-investment leads to lower project risk, and with project risk I mean sort of the asset beta on the investments, but higher leverage. So we're going to take these predictions to the data. We use a sample of 62 Norwegian portfolio company investments made by 11 PE firms across 20 funds, 98 to 2008. And we received the fee information, which is the trickiest to get from a large institutional investor. Portfolio company financial statements and ownership are from the Norwegian Corporate Registry. We need to measure leverage at the group level, and this has to do with how buyouts are structured in Norway, where firms initially put the leverage on the holding company and then transfers it like a year later to the group level. So we measure leverage at the group level. We need to take this holdco into account to get that correct. Asset paydowns are obviously not observable from private firms. So there we do a propensity score matching. We identify public comparables and measure asset betas from there, infer that. Private equity partners and associates are identified from fund websites, and then finally we obtain wealth data from the Norwegian tax authorities.
Erin, what if somebody leaves? How do you?
So then we keep track of when they left relative to the investment. Okay, so we have so Karsten has been doing that for many years. But of course, it's possible that we miss something, and I would say that a weakness is that we cannot see exactly which individual is responsible for different investments, because it could be possible, I think, that if you were responsible for an investment that you actually did more of a co-investment, but we just assume that all partners participate equally in the fund for the investments made when they are there for the investment decisions.
I think you participate in a fund, and so you would be equally exposed to any underlying investment. You wouldn't have been.
And maybe you would have equal influence, because that's sort of the assumption we do.
Makes sense, but because the investor there probably has the due diligence documents from back then, so that they would have whoever partner at the moment they raise the fund, and then you would know historically whoever partners.
Right. So we've looked at these documents. Just some summary statistics to show you what Norwegian buyouts look like. On average, the co-investment in these Norwegian funds were 3.7%. That's slightly higher than what you see in a typical U.S. funds, where I think from Sensoi's paper, Burke & Senso, it's more like 1.5%. It ranges. There was actually one firm that didn't have any co-investment, up to 15% for one firm. But as I said, average 3.7, medium 1.5. The absolute investment in dollar amounts per portfolio company is $13 million. So these GPs, they participate a lot. As a proportion of their reported wealth, it's about 93%. Then it has to be said that the GP's wealth, it's from tax statements, and then it's typically underreported. So I would say it's probably not as high as 93% of the real wealth. But since this is going to affect everyone, we think that in the cross-section, hopefully it won't introduce too much noise. And then you can see our portfolio companies, on average, they have a beta of 0.47. Again, that's relatively low, but that's consistent with studies from the US, and a leverage ratio of about 60% at the time of the transaction. So starting just looking in the univariate, I mean, the model predicts that when you have a high co-investment, you're going to want to reduce project risk but take on more leverage. So we just did a double sort. We sorted these investments by leverage, and we sorted them by asset beta. And you can see that here are the ones with high leverage and low asset beta, the ones where we predict that high co-investment would give this outcome. You can see the average relative GP co-investment here is 1.4 compared to 0.5 for the group high asset beta, low leverage, with a significant difference. Of course, this is just in the univariate, but at least in the univariate, you seem to have this pattern.
Yeah, we have a question here. We're wondering about something. So what you call co-investment, it's the GP on investment in a fund, right? It's not
Yes.
the co-investments of LPs.
I
would call it on investments, actually.
On?
Yeah,
Okay.
because co-investment is really this
Okay, so maybe we should change name
People would
to it
immediately
too.
think about VLPs co-investing. But it is the on investments in a fund, which means that you decide at the time you gather a fund, you decide on how much you're co-investing then. You haven't seen the projects yet, right? So, and also in your descriptive statistics, you put them by investment, but if a fund has done 5 of these investments, the 5 co-investment would be the same number because it is at the fund level, not at the investment level.
Okay. So this would be, so we do cluster standard errors by fund for this reason. No, but this would be the dollar amount, so that would change, but you're right that the percent would be the same. So there are 2 things that changes over time. One is the partner's wealth, because we see that reported year by year, and the other one would be the investment size. So the relative co-investment would be different across...
But related to that, then it means that you may observe some investments now with high leverage, but it's not that then the guy has adjusted the co-investments because this was a high leverage investment, because this was decided 3-4 years ago.
Right.
So in a sense, you need to have some persistence, that the fund always invests in highly levered things, so that how much the guy decided to invest in his own fund depended on this strategy in terms of like how much leverage we usually take, how much risk we intend to take with that fund. You see what I mean with the different timing?
I would actually say the opposite, that it's a strength that you first decide the co-investment percent and then things develop and you make decisions about the project, because alternatively everything would be endogenously determined at the same time.
So you're saying, okay, so it's because I was thinking of the endogeneity the other way around. So yes. You say the guys put some money in, they didn't really think about what the risk will be and what their wealth will be, etc. They somehow exogenously decided that it was like 3%, and then when they have a project, they say how much risk we're going to take for that project, and oh, hold on, I have co-invested quite a lot, and so I'm going to adjust the amount of leverage and so on. So,
right. So of course it's a bit of an extreme assumption, and there will always be some endogeneity, but I think that would mitigate the concern. And I think that
I hadn't thought about it that way, but yeah.
The co-investment is also set in negotiation with the limited partners, so you may not be able to control it entirely.
I think that would be useful. I might have missed it, maybe you had said it, but to say like, this is what we think is exogenous, this is determined first, and then later on they have to decide on how much risk they're going to take. And
exactly,
that's the endogenous part.
In the portfolio investment decision.
Didn't understand. So why are you only focusing on certain investments of the fund? What was the data limitation? You're only looking at 62.
Okay, so we are looking at the investments that they made in Norway, because we can only look at the Norwegian partners, and some funds actually do investments in other countries too, and they can have some local partners. So the way we looked at it was we assumed that the Norwegian partners are responsible for the Norwegian investments. You're saying that we should include their... But okay, so it would be the same, but the question is, if you're the one making you're not the decision maker. That's how we thought about it anyway.
Capital, I would be very surprised.
We should at least think about it. Yeah.
You have the observations, you might as well look if the effects are the same. If you find them a bit weaker, that could go towards but because you had less. Closer to a microphone? Okay.
Okay. So let me get to the cross-sectional regressions. So here we're going to regress then on our risk variables on the left-hand side. We're going to treat the relative co-investment as if it was exogenous, given that the level has been decided earlier when the fund was raised. And then we're also going to replace it just with the absolute, both co-investment in percent and in dollars, to see what really does impact these risk proxies on the left-hand side. We include a range of portfolio company characteristics. We have industry dummies if they invest in different industries. We have either year dummies or some macro controls accounting for business cycle and spread and things like that. Anyway, so the first regression, we have asset beta on the left-hand side. And remember that the theory predicted that the higher co-investment, the lower asset beta investments these firms would choose. And you can see that the relative GP co-investment, which is the co-investment in dollar divided by the wealth in the preceding year, is negatively associated with asset beta. So that's consistent with the model. And also, what you can observe that if we only look at the GP like percent that they co-invest, like 1% or 2% or whatever, or the dollar amount, it's not related to the asset beta. So here, things only come out if we adjust for wealth. And this is true. We have done different measures. This is the partner measure. We do it for a broader set of associates, etc. The results are the same. Then we put leverage on the right-hand side, and leverage is positively related to the co-investment. So the more they co-investment, the higher the leverage. Again, as predicted by the model, and again, the absolute measures for co-investment are insignificant, so you need to wealth adjust. Then we said, well, I mean, in principle, you could lever up so much that your equity beta isn't any lower. So then we wanted to see what effect it had on the overall risk that the PE fund takes with its investment, and that's obviously in the equity beta. And actually, equity betas also are lower the higher the co-investment. And again, this is significant only for the wealth-adjusted co-investment, not for the absolute numbers. So overall, it seems that the funds with higher co-investment, they do lower risk-taking. And we also try a different measure for risk-taking, which is ticket size. You can think about diversification with how many investments a fund makes. So it can make very few investments, or it can make many investments. And the way we measure ticket size is the size of the investment in a given portfolio company divided by the fund size. And actually, you can see that firms with higher co-investments, they also have a lower ticket size, so they choose to have more, like a higher number of investments in their fund, which could be another channel to reduce risk, project risk.
I may, and I try to speak at the microphone. So indeed, like the measurements of beta, as we know, it's extremely rough, right? And plus, when you do an asset beta and an equity beta, you make some assumptions in terms of Modigliani, Miller, and the like that may or may not hold, and you assume certain things about the leverage, which is not exactly like the way the leverage is structured in private equity. It doesn't really have a linear effect on beta because of the way it's structured, etc. So indeed, I was going to suggest some alternatives to measure risk. So I like the fact that you're using ticket size. To me, is the one that makes most sense of all of them, and the one I'm most reassured by. In that spirit, I would look at if you look at how diversified they are across industries, for example. So if a fund tends to invest in the same industry, it's clearly going to be a lot riskier than if a fund has a very, dispersed type of investment strategy. Anything of the sort would reassure me. Also, because you have the returns, you could look at how there are, fraction of bankruptcies or how many returns are negative or things like that to get a sense of how dispersed the returns are, especially on the downside. The absolute amount of leverage, or like how the leverage was also structured, dying at the least amount possible on these betas that are measured with great error. And
we tried to look at returns, but didn't really find anything. And I think the suggestion about industry concentration is interesting, but there I would have to look, because some funds, they already have an industry focus in their fund charter. And then, so this would only then be of interest when you have a very open fund charter that allows you to go across industry, I guess. But I think we should do that too, because of course more more proxies would
But
be
it would
better.
be linked, I mean, to your hypothesis. If I'm forming a fund that invests on a single industry in a single country, then I decide not to put like too much co-investment because it is clearly a very concentrated fund. What if my charter says you can do whatever you want and you can be very diversified? Then I think, okay, it's a fairly safe bet, and so I can co-invest a lot more.
Right, but then you're thinking more about the incentives that the fund raise. We should look into that because more proxies is obviously better.
They are doing like style drifting or things like that, yeah. Yeah.
So John said that it would be interesting to see if they're interested or if they invest in industries that are prone to more bankruptcies. And yeah, I think. Yeah, thanks. So anyway, to sum up, so we examine the effect of the general partner's own investment, as Ludo says, on risk-taking in private equity funds. And we show in a simple model that a higher co-investment, higher relative co-investment would lead to lower project risk and higher leverage. And when we take the predictions to the data, I mean, we find exactly these associations. So our risk measures, asset beta, equity beta, ticket size, they're all negatively correlated with the relative GP co-investment, while leverage is positively correlated with measure the relative GP co-investment. And in none of these left-hand side variables is the absolute co-investment is it correlated to the absolute co-investment in dollars or in percent? And that can also explain why previous literature hasn't been able to show any effect of the co-investment in the fund, because you cannot ignore the general partner's wealth when looking at the incentive effect from these investment requirements. So.
I'm told, if you want to load. Okay, yeah, because we are told to ask questions at the end, but we can ask a question now, and then the question from the audience may come a bit later.
Oh, okay. Oh, so my question is very interesting. I think you've got different potential ways of increasing risk, right? And this doesn't come out of your model, but maybe there's a nice trade-off that the partners face here, right? So if you think about project risk measured by asset beta versus leverage financial risk, right? If something goes wrong, the PE can step in and fix the problem with the financial risk by, injecting more capital, doing whatever, versus the other is harder to avoid. But there may be some kind of trade-off between how they add risk to the investment over time. So if you take, for example, time periods where if you think leverage is largely driven by, whatever the banks will give them, right? Lever up more, maybe they reduce asset risk to offset that, and vice versa.
I think that's a very interesting comment, and in particular thinking about the fact, as you say, that leverage is something that exposed the PE fund or PE firm can actually choose to, with that risk-taking might be less risky than the fundamental risk of the business. So I think that's an interesting
that's linked
point.
also to the comment on like the beta on assets and equity, etc. The implicit assumption you make on leverage, because there are different kinds of leverage. You can be 80% levered with like non-amortizing, or it can be like fully amortizing. It can be any indication of that sort, indeed.
Unfortunately, the Norwegian buyouts, they are predominantly bank funded, so they look relatively similar. So it's leveraged loans, really. Very few public.
A combination of junior versus.
Yeah.
Now it's Eddie.
Take away from you. So, oh. Tell me if it's not better. Thank you. Is that? Oh, yeah. Okay. This is extremely early work, and I'm interested as well to get some discussion and feedback here. It's joint work with Jonathan Cohn and Erin Towery, and what's kind of intriguing about the work that Jonathan and Erin have done before is Erin has a joint appointment with the IRS. And so much of the work she's done in the past, not just on private equity, is based on corporate tax returns for U.S. firms. So that's where we're headed here. Okay, so in the private equity space here, myself and I think most of us are constrained, unless we have this interesting data from Scandinavian countries and so on, but we're constrained to looking at public companies for the most part, or firms that are providing information on an ongoing basis through SEC filings. So there's been a lot of study of the public to private buyouts, the earlier era that Jensen talks so much about, and Kaplan did much of the testing there. A lot of work there, and basically saying that we had poorly governed firms, but when you impose this structure and take them private, they tend to perform much better. So that's kind of the takeaway from that. Whereas more recently, in my co-author's work, and again some of my own work, when you start to look at this in the more recent world of private equity, it's much less clear that they're creating value with these underlying portfolio investments. And so, like I said, a fair amount of study on the public to private side. If I jump down to the third type of transaction that's important in this industry is divisional buyouts. Again, I don't think there's very much work there certainly relative to public to private. The piece that we're going to study in this paper, though, is the private to private transactions. And when you start looking around on Capital IQ or any of the others, you realize very quickly, at least in terms of numbers, the vast proportion of what's happening in this market is falling into that sector. Unless you start to look in other countries that do have data available, such as Bouclet et al., look at French buyouts. There was a doctoral student from Ohio State a couple of years ago looked at UK buyouts. Unless you have some other source of information, you really can't look at these transactions and how the underlying portfolio companies perform. The other exception to that is folks who have worked with the census data in the U.S. Can look at measures like total factor productivity and see the impact of the buyouts that way, but then that's looking, again, at a very specific measure of performance for those firms. So we're going to add to this middle sector, or this middle piece, this type of transaction by using this IRS data that Erin has access to. So I guess I don't have a disclaimer here. If she were presenting it, she would have a disclaimer here. The interesting thing for me is working on this project with them is I'm actually never allowed to touch the data, and she's only allowed to touch it when she's at the IRS. So I've never written a paper myself before where I actually didn't touch the data. So what we're going to look at here, a couple of broader questions. What are the motivations for these private buyouts of private companies, which will again help us understand what their models are for creating wealth in the portfolio companies. We'll do that empirically by looking at a model to try and predict what type of private firms are bought by private equity, and then try and see if that helps us learn about the variation in performance of these companies while they're under private equity ownership. Okay. So to give a contrast between thinking about buyouts of public companies, so the public to private transactions, versus what we're going to focus on here, I mentioned that I'll call the older argument on the public to private ones. I don't have to look there, I can look here. Targeting firms that have excess free cash flow. So empirically looking for firms that had high cash flow but low investment opportunities or low Q. And the argument is that when the private equity firms come in and they can increase the concentration of ownership, have the ongoing monitoring by the PE, that is the source of the value gains. Now, that's clearly not going to apply when we start looking at private companies because the targets themselves are already concentrated ownership. So it's going to have to be a different model that we look at here. The other arguable source of value creation on the public side is operating partners on the PE firms that do things to assist firms in improving their operations. Obviously, increasing leverage through tax shields. The other thing we found is a strong effect on the public side is just simply timing. So buying and selling at times where you have multiple expansion are very important in explaining the returns. So, it's pretty clear that these may or may not apply in the context of buying private companies. Probably the operating experience of the private equity buyers would still carry over onto the private side. Whether increasing leverage is one of the key motivations, I think is more open to an empirical question here. So in the earlier work that was done looking at the French buyouts and the UK buyouts and so on, what they were finding was that the firms were not getting so much from an increase in leverage, but that these were firms that were already relatively highly levered and were hitting financial constraints. And so the benefit to bringing in a PE in these cases was to allow them to grow further without these financial constraints. So increasing leverage, it's not clear that that's as applicable in the case of private firms. As I said, still looking for high growth opportunities. The other thing that comes in with on the private side is that often, if not being founder-owned, they're in a situation where the owners of the firm want to cash out. So providing an exit or providing liquidity. In some cases, it's a pure exit for the existing owners. In others, especially for tax purposes, they'll roll over some portion of their prior stake, but they're still largely cashing out a majority of their ownership in the firm. Okay. So again, our empirical strategy is going to be, we're going to look at a model that tries to explain how do we predict which private firms become targets of private equity buyouts, to speak to the motivations for the transactions. And then we're going to look at the post-buyout performance of these firms once they're under PE ownership. And a little bit of a preview of the results, and again, like I said, this is work in progress. This is how far we've gotten so far. But what you find is a strong I'll call it nonlinear effect, in that the PEs seem to be targeting firms at both extremes of performance. So targeting firms that have the top level of industry adjusted performance, and at the same time targeting firms at the bottom levels of performance. So it's not an easy monotonic relationship, and they seem to be picking these extremes. But what we see is, given you're at one end or the other of the spectrum here, they seem to add value in different ways. And so for the better performing firms, it seems more consistent with the evidence that we've had from the European buyouts, where they're relaxing financial constraints and allowing these firms to grow. Whereas for the lower end, where they're in more of a turnaround situation, the gains seem to be coming from the increases in profitability of the portfolio company. And the piece that we are still working on, and I'll maybe get to this a little bit at the end, is trying to understand what they are doing in these more of a turnaround situations, and does it seem to be whether it's because they're making changes in the governance of these companies that enables them to improve their profitability. All right, so just a couple things on the sample itself. The main constraint here is that they have to be, and I'm not the tax expert here, but they have to be C Corps, corporations as opposed to partnerships. And so that cuts about in half of the firms that we can look at here, but we still end up with a sample of 240 firms that we can look at the performance of the firms after they're bought by the private equity company. So I feel a little better after seeing Karen's paper with 62 observations with my 240.
Erin?
Yeah.
So, we have accounting data in Capital IQ already for a lot of firms in the US that are private equity held because they have like publicly listed debt or like these sorts of things. And it's already more than 240 observations, right? So how...
But those would be prior public firms. So
Not-
you're
not
saying so you could have
necessarily.
firms that were...
Yeah, you'd have some private to private that just would issue some. I mean, a lot of them are public to private, but you would have a subset that would issue some public debt, and they were private before, and so you would also get the accounting of these ones on Capital IQ. That could increase your sample size further, and also see whether there is an effect of being a C corp per se versus not, or things like that.
Yeah, that's an interesting point.
It's a bit surprising that you end up with only 240 observations. Starting
Yeah.
point, while only 800 to start with, they're like 10,000 private.
The issue is largely whether they're partnerships or corporations that drives it down to begin with.
But here you start with 800,
Yeah.
while to be 10 times as many in Capital IQ. So I wonder if it's like if you filter on assets, because Capital IQ often doesn't have the enterprise value, and then maybe then you kicked all this one out while you could have merged them anyway with IRS.
Yeah.
From a low number.
Yeah, I'll have to, we'll go back and look at that. It's, my priors are it's going to pick up a different type of firm, much larger, because they start out larger to be able to issue public debt. But yeah, definitely.
The other thing is about when you talk about growth, but you tell me if you are going to cover that, about whether this is it was possible in this IRS data to distinguish between inorganic growth versus organic growth.
It's not possible within the IRS data, but I'll get to this in a little bit. I actually don't have the evidence on that yet, but we do look for evidence of add-on acquisitions. So through Capital IQ, news stories, and so on. So the best we can do there to distinguish is a kind of a count of, in a given year post-buyout, had they made any acquisitions or not.
Yeah, but then you rely very much on Capital IQ being comprehensive. I think it's really what the big missing thing in the literature. So earlier we discussed that you say in the US they're not too much add-on, but I have in mind a paper written on by some people at LBS where they just showed that post-buyout, the LBOs have a much higher growth rate in EBITDA compared to like similar companies that are not under buyout. But if you don't take into account M&A activity, it's almost by construction you will observe that, because half of the transactions in private equity are add-on acquisitions. So if you don't take that into account, externally financed add-on acquisitions, by construction you will find that private equity grows a lot. Private equity-owned companies will grow a lot better. So I find it like I'm always very nervous that this piece is missing. So maybe in the US it's not as big, but it's one deal in two. I thought also in the US that is an add-on acquisition.
So missing just because they're not reported in Capital IQ?
Just because we don't know. Yeah, they are not there in Capital IQ. I mean, the LBS study made no effort to even like try to look at them. So then by construction, it's highly biased. But if you did it in Capital IQ, you need to know not only that there was an add-on, but you need to know what was the value of this add-on, how much equity was injected in it, etc., which usually Capital IQ wouldn't give you anyway, even if they give you the add-on.
Yep.
So that's, I think in prior work, you scale by total assets or something like that, which probably like alleviates this concern, because if you work on a scaled measure of earnings, and somehow the total assets reflects the add-on acquisitions, then you would alleviate this concern. But to me, it feels like a first-order concern, and I never completely understand if in the literature it has really been addressed or not so far, which always makes me a bit nervous to know whether they do add value or not, because I don't know exactly like whether we had the clean samples so far.
Yeah, so we can scale by assets when we look post-acquisition. You can't look pre to post. But if we're talking about add-on acquisitions, we can scale by total assets afterwards. We're using more than Capital IQ, so we're also going through Preqin and other sources. So it's really an issue of data limitations. But Preqin, at least, you see a lot of this activity. So maybe we're missing some, but at least we would get some variation in being able to identify the ones that are likely have more add-on acquisitions than others. it may be a good indicator, if not an exact. It leads me to my third point is you're exactly right. Even when you have information about an add-on acquisition, they tend to be acquisitions of private companies. And so the terms of those deals are never disclosed, and you never know the amounts. So you can just use the presence in Capital IQ or Preqin of one of these add-ons as an indication of something significant. And that's probably the best you can do.
But this is where I'm not an accountant, so maybe an accountant or like some, you know better. Like if you have the anti-IRS records, isn't there a provision somewhere, a line somewhere that would give you an indication of how much extra capital had been injected in that company to finance? That's what I'm hinting at as well.
Yeah, we do have that only from, again, Aaron knows these better. I think from 2005 forward, the IRS data also discloses for us that piece of information. So we do have it for a piece of the sample. But again, it's only going to be the equity contribution, which could be for other reasons, but I think you're right, it's likely for acquisitions. Or if we see that, that's a good point, if we see that kind of partnered with other indications that there are acquisitions going on.
We really care if they get additional funding. Obviously, it releases financial constraints and it allows the company to grow. But do we really care if they grow internally or through acquisitions?
We do, because on the comments on you're going to look at whether the growth in EBITDA is higher for private equity held business versus not. And people say, look, if I look at growth in EBITDA, growth in sales, and so on, it's higher for private equity owned businesses in the same industry. But it's like by construction, it will be. And then people take this higher growth and say, that's evidence that they create value. If it's externally financed, they haven't created anything.
Yeah, I mean, but I agree with you in the sense that you will find growth. Right, but when you see that accompanied with increases in profitability, then it is telling you something. Yeah. Okay, great. Okay, so anyways, this is just showing you both. We're going to look at buyouts from year T is the year of the buyout, so we'll look at it from pre-buyout to a number of years post-buyout. Okay, and I'll show you in a second. The first thing, as I said, we're going to build a model helping us predict which kinds of firms are purchased by the private equity companies. This is just a little bit of sample description. And generally much smaller firms than we've studied, obviously, in the public to private transactions. The other thing we're going to do is look at their pre-buyout performance using both a continuous measure but also separating firms into quintiles by that pre-buyout measure of performance. And the measure of performance that I'm going to show you is just the industry-adjusted return on assets. We use return on assets rather than some kind of other measure of profitability, return on sales, and so on, because we feel that gives us our best estimate of what the potential return on investment would be from the PE's point of view. Okay. So like I said, we want to broadly consider what the motivations would be, exploiting these differences in the pre-buyout performance, and get at these issues of are they adding value because of the ability to relax financial constraints, so exploiting their need for financing, and then also looking at the pre-buyout leverage as an indication of whether they're likely constrained. Okay. I'm not sure if I made this too small for the size of a room, but what we're doing is a linear probability model, basically predicting the likelihood of a target. So the things to focus on, if I've got here, when you simply look at it as on the right-hand side, the pre-buyout performance has no predictive value. But once we start to look at the performance based on quintiles, so we've got the top performing here and lower ones here, and we're leaving out that middle group, what you see is at both the top end that I put in red and at the bottom end, also in red here, a much higher probability of being targeted by the PE firm. So if we look at the unconditional probability of being purchased for the full sample of private companies in the IRS data set, it's about 1.6% of companies. So what this is telling us is that if you're at these extremes of performance, you're almost twice as likely to be purchased by a private equity firm. So that's our kind of first main finding, that we have this non-linear relationship. And I think what people have focused on in the buyouts in Europe and so on is really the performance at the top end here with the growth versus growth and relaxing financial constraints story. What people haven't focused on quite as much as what PEs are doing when they purchase these underperforming companies. The next step is to see how does this relate to the pre-buyout leverage, right? So the older story about value creation was adding tax shields through levering up. And we're actually seeing here it's loading positively on leverage. So this is more consistent with firms have borrowed as much as they can, they've hit their financial constraints, and the PEs are going to come in and help them grow despite the fact that they had reached their limits on leverage. So taking that just a little bit further here, we want to look at that relative to how dependent on external financing the company is. So if I have a firm that's highly levered and you're in an industry that much of the CapEx is being financed externally, and we use a somewhat standard measure here, this Rajan and Zingalis measure of need for external financing. So if you're already levered and you have good growth prospects and you're in this more constrained, more need for external financing group, so this three-way interaction here, this is the group where we're seeing the highest probability of being targeted by the private equity firm.
Like to include some year dummies here or time controls? Because I'm thinking, like during the financial crisis when asset values were low, we saw a lot of PE acquisitions, and they could explain the low ROA. And similarly, there was a lot of acquisitions also in other periods, because you would like to know the cross-section within for a given economy.
Yeah, I'm pretty sure, and this is where I'm always at a disadvantage where I'm not the one running the regressions, but I'm pretty sure Aaron has included those. Sorry, trying to remember back, we've actually run it both ways. Okay. Yeah. All right, so that's our first main kind of goal. So to push further on this, then we want to look at the post-buyout performance and see how they may be, first of all, just even documenting how they're performing, and then seeing how this ties back into the arguments about what the sources of value creation might be, and why they might differ for these, buying a well-performing company versus buying an underperforming company. So the first measure that I'll show you, again, year T is the year of the buyout. So what's the evolution of the profitability in this case, the pre-interest ROS. So again, being constrained by the IRS data, we can't look at EBITDA and some of the typical measures that the literature looks at, but this is very highly correlated with these cash flow measures. And my co-authors have shown that in some of their earlier work. So the thing that I would take away, and I'll show you this more in terms of statistics in just a second, is that if I look from the time of the buyout going forward, it's this bottom quintile group, and by the way, these are, I'm pointing at the screen here, that doesn't do any good. These are performance adjusted, so we use our first stage model to do a matching procedure where we can look at the performance of the target company's post-buyout relative to a matching firm. Our next step would be to expand on this and use a propensity score matching model, but this is very close to that. And so what you see for the bottom performing, so when they've targeted underperforming companies, you're seeing these increases in profitability post-buyout versus when they've targeted the better performing companies. So if I look down here, they're also showing an improvement, but they had a large drop from T minus 1 to T. So I think maybe if we look at the statistics, this is perhaps a little bit clearer. So looking at post-buyout performance, if we look first at all transactions here, overall, so I'll show you unadjusted, industry adjusted, but I think the most relevant one here would be this compared to a matching firm. So looking just at comparison to the matching firms, overall in these buyouts of private companies, they do seem to be increasing profitability. But you see that mostly where that is occurring is when they've purchased underperforming companies, and less clear and insignificant changes for the targeting the better performing. Same type of picture showing ROA. Again, you're seeing larger increases in profitability post-buyout. For the red line is targeting poorly performing companies versus the black line targeting the better performing ones. I won't show you the statistics for that one. This relates a little bit to Ludo's question a second ago. What happens to overall growth? Okay, and I think the interesting thing here, maybe less so this red line, which is the underperforming companies, to the extent that they had just experienced pretty severe drops, and that if they do recover, we'll see an increase in sales. But it could be coming from that, or it could be coming from add-on acquisitions and other types of growth. So we're going to have to figure out, it's not surprising that it's increasing so much, but we'll have to figure out why that is happening. Probably the more interesting thing here I would take away from it, though, is the better performing targets, we're not seeing any significant increases in sales or growth. And I can just show you, again, the same thing in terms of the statistics instead. For the bottom performing, so this is actually the change in sales growth, not the change in level of sales. The change in sales growth is actually not significant here for the bottom, but for the top as well, we're not seeing increases in sales growth post-buyout. Okay. Let me quickly show you the outcomes here. And now I'm starting to tread in territory of things that we haven't been able to incorporate into our analysis yet, but where we're headed here is like I said, trying to think about tying it back to the motives, how they believe, or how we believe they may be creating value here, and then seeing if cross-sectionally we can use those ideas to explain those differences in performance. So if you look at the outcomes, I think there's some interesting differences versus what we know about the public to private transactions, and a very large proportion of the exits for these companies, but they're not going to be going to the IPO markets because these firms are largely starting out much smaller. So even with the growth potentially from add-on and everything else, it's not clear that they're going to make it to the IPO market. So a striking thing here is that very large proportion of the exits here are going to be to sales, and it's largely split about half and half between sales to strategic buyers versus sales to other PEs, sales to financial buyers. I also find it kind of interesting if you look within the top and bottom pre-buyout performance groups, we're seeing a difference in outcomes. So for the underperforming ones, again, the exits are pretty much split half and half between sales to financials versus sales to strategics. But within, that's in the worst performing ones. But in the better performing ones, some of them are still being held much longer in the PE portfolios than we typically see for the public to private transactions that we've looked at. And much more likely to be sold to strategic buyers rather than going to another financial buyer through a secondary buyout. So we're seeing an interesting split, I think, here in the type of sales based on why they were bought in the first place. Okay, so here's what we're hoping to look at. I can't show you our results yet, but ultimately there'll be some cross-sectional tests here tying into all these arguments. How does this post-buyout performance relate to why they were targeted in the first place? So what the pre-buyout performance was, what the pre-buyout leverage was, who did they buy it from? Was it a founder or owner cashing out? Was it bought from another private equity firm in the first place? Many of these are actually management buyouts, which we don't see very much of these days anymore in the larger space. And in the cases, especially of the underperforming firms, can we attribute the gains in profitability to changes in governance that they've made? So we've been doing some work tracking who the CEO and so on of these companies are and how that changes at the time of the buyout. Okay? So that's where we are as far as we've gotten. Again, just to recap here, I think very strong and maybe not expected result here is that the PEs are targeting both at the bottom end and the top end of performance more likely than the middle group. And then what you see post-buyout differs for those groups. It's the top group is more consistent with the European evidence on relaxing financial constraints and allowing growth, but the bottom group looks more like turnaround situations. Some other interesting things, at least to me, that have come out of what we've done so far is They do seem to maintain these as portfolio companies longer than we've seen by looking at the larger public-to-private transactions. Much more prevalence of sales as an exit strategy, and where we're going in the future is we are going to do our best to look more at understanding the mechanisms behind this behavior.
Thank you. So like we said, if you want to ask questions, we would have some time at the end for that. And then I'm going to go there. All right, so this talk is going to be different. It's not going to be an academic study. It's going to be some thoughts, some literature review, some things mixed together. What you see there is a book which you should buy if you're interested in private equity. It's a good book. It's not expensive, and you should recommend it to your students. It's my course in private equity that I teach at Oxford. So one thing I want to start with in terms of understanding some mega trends and things that are maybe shaping up the private markets. So not just private equity, but private markets in general. So real estate, private credit, etc. The world of private markets. So one thing to bear in mind is that we have seen an increased concentration of capital. And it's like crystal clear, it's very strong, and this is a big deal. We see it not only for very large entities, so these are like the 15th largest asset owners in the world, and you can see that they all have more than $300 billion under management. We've never seen that many people with that amount of money in their pockets at any point in time. Even at smaller levels, so for example, at the University of Oxford, every college we used to have their own small endowments, and then this has been concentrated with one big endowment at the university, and now this endowment is like $10 billion. Again, that we didn't have that kind of concentration of endowments in the UK. It's the same for Cambridge University. They have now a $10 billion endowment. So everywhere we see this concentrations of pension funds as well in the UK is on the road, etc. There are some talks about merging the AP pension funds in Sweden. So big concentration of capital going up. Now, these guys are arguing that they don't want to play with public markets anymore. So public market being public equity or public debt, bonds. They say that these things are too small for them. They are so big that like these listed equity markets and listed debt markets is just too small for them. They just have too much capital to deploy. They point out that there are less stocks. You know the statistics in the US. They used to, at the peak in '98, there was like 8,000 stocks. There are like less than 3,500 today. So the number of stocks in the US went down quite dramatically. The same in the UK. It's not all the same in other countries, but at least in the US, much less stocks. The counter-argument is that the stocks that are gone tend to be small stocks. So it's not clear that the pond has shrunk so much. The total market cap in the US has been pretty much constant over the last 20 years. So the number of stocks has been divided by 2, but the total market cap has been roughly constant. But these guys have been growing, so the pond is a bit shrinking for them. The other thing that they say, this hasn't been tested yet, so this can be a good research project, is that there has been increased concentration on the listed markets. So if you take a textbook that hasn't been updated for a while, an investment textbook, they will tell you to invest in the S&P 500. Like, that's a market portfolio. The S&P 500, 37% of it is tech and financial companies. When you buy the S&P 500, you're basically buying Facebook, Google, Apple, etc., which are in pretty much the same type of business. And so you're basically buying just like 2 industries. In one country, only very large companies with a very similar business model for a number of them. So one argument is that maybe the pond hasn't shrunk that dramatically, but it's extremely concentrated. And so if I want to be diversified, if I want to be exposed to taxi companies, if I want to be exposed to a number of tech companies, a number of also traditional things like restaurants, then I have to go the private route. If I want exposures to restaurants, hotels, car rentals, retail, etc., this is like basically all outside of listed markets. And so then if I want diversification, I need to go outside of a public bond. And so I say maybe because we don't really have like a good test of that that I know of, but maybe. And then they say as well that these public markets are not made for them. These guys have long horizons, they are very big, and they don't care about trading every milliseconds. And that's what public markets are offering. The main thing that public markets is offering is that you can trade every milliseconds, small amounts, at basically no transaction cost. They say that's not for us. We don't care about that, and actually it's terrible for us because whenever we show up, we are front-run by high-frequency traders and the like, and so we have to rebalance only by using block trades. So we do it off exchanges anyway, or we do it at the close, at the auctions at the close or at the beginning. So de facto, we are doing over-the-counter. We're not using public markets. They're not designed for us, and they're actually hurting us if we play with them. Then another thing that they say is that excess volatility is killing us. And so there's some literature saying there is excess volatility on listed markets. Some people say no. It's hard to know whether there is excess volatility or not. But one thing that they say, these asset owners, is that especially people that are regulated, but even the ones that are not. So imagine a public pension fund in the US. If their funding ratio goes below, let's say, 80%, they have to spend all kinds of energy, time, and cost to go and renegotiate with a treasurer or the other stakeholders, regulators, and the like, and rebalance their portfolios, do all kinds of things that are costing them a lot of money. Now, as you know from Finance 101, if you have two motions that have the exact same average returns, expected returns, but one is more volatile than the other, the more volatile one increases the probability that you hit the barrier. Right? So if you have two investments that gives you 10% return, but one has a lot more volatility than the others, you're much more likely with a volatile one to touch the 80% funding ratio. Right? So what happens if you put too much money on listed markets, you're going to hit this barrier more often, and you'll have to do all these negotiations with your regulator and the like, and that's going to be costly. And so you don't want this excess volatility. You want something that is going to be a lot smoother. And that's what private markets would bring you, because in private markets you don't have this excess volatility. Maybe you have under volatility, maybe it's underreported, but at least you don't have the potentially excess volatility of public markets, and that saves you a lot of money and cost and so on. So I say, another thing that annoys us with public markets is that they are potentially excessively volatile. And the answer is maybe because, again, some people say that there is not really excess volatility. The volatility on the public market is the right one, and on private markets an artificial one. And then you have some people saying, yeah, but even on public markets it's excessive compared to what it should be. And then they say, a bit the argument I said earlier, it doesn't deliver the market portfolio. We don't have, like, all kinds of industries are not listed. If you want exposure to that, you need to go private. If you want exposure to Uber or restaurants and so on, you need to go with the private markets. So the question is, well, do you need the market portfolio? Maybe the S&P 500 is good enough a proxy if it's 99% correlated and cheaper to get than just stick to the S&P 500. Do you really want the extra cost? And so that's what's written there. Also, if you go broader than the US, if you want to be geographically diversified, if let's say you want to be exposed to Africa, if you want to be exposed to China, etc., the listed market is a very poor route to be exposed to these economies. In Africa, you would have like 10 stocks, and most of them would be subsidiaries of Western companies anyway. You won't be exposed to Africa growth by having listed stocks in that continent. You want to access the equity market in China, also only the listed one, would also be like pretty restrictive and expensive and so on. So if you want to be geographically diversified, you need to play private. And if you have tons of private equity funds in China, tons in Africa, and they can give you this exposure that the listed markets wouldn't give you. So industry diversification, but also country diversification, you would need the private markets if that's something you want. The question is, is that extra diversification bringing you enough benefits to justify the extra cost? And then there is the other argument that because the markets are efficient when it's public, if I want an alpha and I seem to want that badly, then I need to go private because that's the only place where I could have a chance to find one because the rest is like so efficient. So basically, they all want private markets. But they need to go via financial intermediaries for that, and that's going to raise a number of issues. But that's basically where they are. Okay, and that's good news because I love private equity and private markets. So that's brilliant that they all want to be in private markets because that makes my work and life a lot more exciting. So now I'm going to tell you a bit of a pseudo fairy tale. So once upon a time, lived some pension funds who was extremely happy with this private equity allocation because the returns were amazing. It had beaten the S&P 500. And on top of that, what was really amazing is that the fees were extremely low. And so, what a better world. You have high returns, you beat your benchmarks, you beat the S&P 500 with your private equity program, and then you pay hardly any fees for that. Cannot be any better. So that's basically a world, it's a pseudo fairy tale because it's very close to public pension funds, US pre-2008 situation. How low were the fees? Here is a pension fund. I've hidden their names because it would be a bit unfair. All the pension funds report the same sorts of fees. But how low are the fees? These are from the annual report of a pension fund in 2004, 2005. After that, they stopped reporting it line by line, manager by manager. And this is officially what a very large public pension fund in the US said they were paying in terms of fees in private equity. So you see there that, for example, I don't know if you've heard of a company called Blackstone, but apparently they didn't charge any fees at all in 2004 for a $200 million allocation. If you've heard of a company called TPG, they charged $338. This is not in thousands or in millions. It's $338 for the year to manage something like a $200 million allocation. That's how low the fees are. If you add them all up and scale by NAV, it would be like 100 basis points, 150 basis points. This situation is still the same in the US, anywhere, and even outside of the US. If you go to the accounting of public pension funds in the US, where they tell you how much is their expense ratio in private equity, like total cost to their NAVs, they will report a number between 100 and 150 basis points. And that would be the underlying data. Okay. So that's fantastic, right? You hardly pay anything. It's cheaper than a mutual fund. Fidelity would charge you more, okay? And you beat the S&P 500, basically, and you can report like no cost. It's like absolutely fantastic world. The New York Times doesn't seem to have seen these low fees. They seem to say that the fees are sky high, but they are very impressed with the returns. And that's by that guy whose job title I envy is called Deal Professor. And he writes this piece that is fairly typical, that's why I show it, about how people perceive returns in private equity. So the journalist is saying, imagine like if we could, have all these barriers coming down, and then people like you and I could just invest in private equity. I mean, it would be like so awesome. And actually, it's a dream about to come true in the US because 401k plans are working very hard to get private equity in there. So that's soon to be reality. In Australia, it's already the case. And there are ways, also all kinds of feeder funds in Switzerland and the like that gives you access to private equity. Anyway, so the journalist is lamenting on the fact that, he cannot access private equity, and it's a pity because this is just a money machine. They give like such high returns, and here are the examples he gives, which are classics. He says, look at the Yale endowment, 36% return from since inception, which was over the last 20 years, the same number since inception. 36% a year. I mean, that's an amazing number, right? Who doesn't want 36% return per year, like over 20 years? Okay. And you have some super achievers out there, the top quartile guys like KKR, I'm sure you know of. They have 26% return since the beginning, which is 1976. 1976 is a long time ago. It's 42 years ago. I know that very well because that's my birth year, so I know how old KKR is. So leverage buyout was born when I was, and my initials are LP, so I think I was predestined for to study this thing. And Apollo also 25%. And so that's the kind of numbers you see very often if you talk to people about, like, what kind of numbers they get on the brochures they receive from private equity and the like. They will always tell you, like, it's 25%, 30%. That's kind of like normal in the private equity space to talk about that kind of number. And of course, it's a lot different from, the 10% you would get in public equity, okay? Like, it's just, the S&P 500 is just like a massive loser. So here is, if you needed a picture about how much of a loser you are if you follow the usual investment textbooks to put your money in the S&P 500, if this is used in industry presentations like pretty often. This is like a pretty regularly used graph. So if you put money in the 1980 into the S&P 500, you would have earned this small box, okay? And if you would have put it in top quartile private equity funds, you would have ended up with a big box, okay? So as like for people who do not like compounding, like so that they can visualize the difference in returns, otherwise you can see that it's $1,000 would have given you nearly $4 million with top quartile firms. If you would have put 1 million in there, you would have got 4 billion, and if you would have put 1 billion in there, you would have got 4 trillion. Right? That's investing in top quartile firms. And so when Warren Buffett tells you to invest in the S&P 500, or when he himself invests in the S&P 500, or the textbooks tell you to do so, you can see how a lousy investment advice this is. You end up like with this tiny box there, instead of like enjoying the top quartile private equity guys. Talking about Warren Buffett, do you know what the return of Warren Buffett is? Over a long period of time. It's 19% net of fees. So Warren Buffett is the richest guy on the planet-ish, and he earned 19%. A quarter of private equity firms makes a joke of a track record. They earn twice what Warren Buffett has earned. Yeah. So if you want to put some numbers, imagine you would have put just 10 million in KKR in 1976 at 26%. Nowadays, you would have 160 billion, which I think would get you to like being the richest guy on the planet, or not far. Yeah? And you just needed to give 10 million to KKR in 1976 and just reinvest what they distributed to you into their funds, and you would have 160 billion today. Okay. Yale, if you just take the 100 million, they invested 100 million in venture capital in 1990, they did it every year, okay? And they grew their allocation to private equity. But just take the 100 million of Yale in 1990, if they had earned 36% a year, Yale would be sitting just with this 100 million on top of $550 billion today. And if you do like every year what Yale invested into and earn 36%, they would have a bit more than the US GDP in their endowment at present. So Yale pays their professors a lot better than Oxford University. But I think we would have noticed if they would have splashed 1 trillion or so on faculty salaries and buildings. So what this is telling you is that these numbers are a bit weird. Okay? They're not real. They cannot be real. So one day, there was this journalist who wrote this he had this newsletter, and then he was all about how amazing Yale returns are, etc. And he was wondering if anybody had matched the Yale killer track record. And because there was a question mark, I thought I should reply. So I said, hi, Dan, to answer your Yale question, actually a monkey starting to invest in venture capital at the same time and pretending that the since inception IR is a rate of return would have exactly the same track record. I actually proved that. I took a monkey, so by a monkey I mean you take the average return in venture capital every year, and then you calculate a since inception IR, which is probably what Yale has calculated, on that monkey's track record, and you find exactly 36%, and you find that it never changes, etc. And you know. Now it doesn't mean that Yale is like a monkey. They might have better returns than that, but because the since inception IR is totally driven by the early years distributions, anybody would have, starting at the same time, would have a similar number. So you don't know if what the true numbers may be good for Yale, maybe bad, we don't know. And So Yale has not been very forthcoming for a very long time. They did for the first time this year. There is a footnote in Yale annual report. This has been going on for a while. I wrote a paper in 2013 on this. So every year, like, their journalists like pushing them, and I make this presentation quite often, and so on. And so it goes to Yale Endowment quite frequently. And this year, for the first time in the endowment annual report, you can find on Yale website, there is a footnote saying, by the way, the 36% number, which never changes, every year is 36%. You can download the annual report from like year 2000 all the way to today. The number never changes for their since inception returns. So there is a footnote that says, this, by the way, is an internal rate of return. That's for the first time they say, but they don't detail the fact that, and therefore you should not take that number seriously, and we will not give you the right number, but, just don't pay attention to that number. But at least there is an acknowledgement now. Sorry? Well, I wouldn't say that, but yeah. So IR is a wrong answer. These numbers were not true. They are not even possible. So what are the true numbers? So hopefully these four guys came up with access to the best database we have for private equity fund cash flows and calculating it the right way with an NPV-based measure, just like we teach people in Finance 101. And they say that buyouts in the US outperform the S&P by 3%, and this is as of the end of 2008. Venture capital not so well, but buyout is 3% above the S&P 500. And so bingo, this was great, because if after all the fees the returns are high, 3% above the S&P 500, we don't need to bother about thinking about fees. We don't need to bother about agency cost. Nothing matters. Let's party. So you go to people and say, hey, Joe, want to have higher returns? I have a song that actually, I would spare you the singing. But the song goes that, if you want higher returns, just invest in fees and in private equity and enjoy the extra cash. And so from 2008 onwards, there has been no questioning about any of the contracts that were being signed, about the fee levels, about the alignments of interest or anything like that. Everybody goes like, listen, these guys told us private equity is 3% above the S&P 500. We need higher returns. We just invest in private equity, period. We don't need to discuss anything. Now, something I want to show you is what 3% above the S&P 500 looks like. So you have here the S&P 500 cumulative returns in green from 1991. That's basically the time period of a study that I've just shown you. So from 1990 to 2008, the S&P 500, as you may know, was fairly flat. That's the green thing. And in red is something that has beaten the S&P 500 by 3% a year. So you see that you get a lot more money at the end than with the S&P 500. Now, this thing could have been private equity returns. It turns out that what I have plotted here is the crisp equally weighted index. What that means is that the average stock in the US has beaten the S&P by 3% a year. In fact, you would have more than like 90% of the stocks in the US have beaten the S&P 500 over that time period. Almost all the investments have beaten the S&P 500, including treasury bonds and the like, because the S&P 500 just had terrible returns. And as I said earlier, the S&P 500 is just tech and finance, is one sector, is one specific strategy. And so, there will be times where this underperforms and some other times where this outperforms. So the average stock in the US has beaten the S&P 500 by the exact same amount than the average buyout fund has beaten the S&P 500. So the average buyout fund in the US has performed like the average stock in the US for this entire 2 decades. Now, if you want to see something even more beautiful, and this has been spotted and so on, this is from that point in time, 2007, to today. One of these series is the S&P 500, is the green one still. You know which one is the other one? It's the average stock in the US. So the last 10 years, the S&P 500 has the exact same return than the average stock in the US. And you know what happened over the last 10 years to average private equity returns? They are equal to the S&P 500. Now, the guys I showed you earlier go around now and say, in our latest research, we find that on the last 10 years, there is not an outperformance anymore because private equity is matching S&P 500 returns. So the outperformance was pre-2008, but the last 10 years, we haven't seen the outperformance anymore. The other interpretation of this, and they say it's because of competitive pressure and all these things. The other interpretation is they have never outperformed. If you compare to the average stock, if you match by book to market and size, anything like that, they had never outperformed. Not before, not after. And it's just because you're choosing the S&P 500 that you find this difference over time. But if you take any other things that looks more like what private equity does, there is no difference. It's always like 1-to-1. So basically, if you want to be optimistic, it's 3-4% outperformance for the average fund in the US, etc. If you are a bit more skeptical, or like you take some other indices or benchmarks, and it's about at par. Okay. Now, how come these guys who are so good? It's a fascinating industry in private equity. Okay, the people working in that industry are like really amazing people. I say that sincerely. I really admire their work, their professionalism, etc. How come these people don't manage to do more than the average stock return when they are so good and so well organized? And the answer is, it's because the fees are not 100 basis points. They are 700 basis points. That's what the fees are for the average fund in the US. So they started at 19, which is amazing. That's Warren Buffett track record. That's the average fund in the US matches Warren Buffett before fees. That's amazing. But if you take 7%, then you end up at 12, which is the average stock return in the US. And the problem is, in a low interest environment, which is what more or less everybody agrees is coming up, if you simulate a fee structure in private equity when the returns would be 10 or 12% gross, you will end up with 6% net. And making it like very hard to see like how you would manage to outperform net of fees listed markets going forward if it is impossible to generate a 19% growth. So there are all kinds of issues on fees. And this is coming up in the US right now. There is Pennsylvania who's like full gas on this, trying to get the true numbers for the fees that the pension funds have paid in Pennsylvania. South Carolina have made a big effort. California has made a big effort. And one after the other, people are saying, all these numbers you fed me all these years, are they really like totally off? It's not 100 basis points, 150, but how much are they? And so there is full gas. This is like really like one of the hottest topics at the moment. And so there is regulation. There is a law that is currently discussed at the Senate in Pennsylvania exactly on that, etc. So it's and in Europe there is also a lot of debate on that. So I won't have too much time to give a perspective on what happened to the MAOs, but basically the MAOs have seen these things. So these mega asset owners, the very large guys, they know all of these things. Okay. So when you present that, they say, we've done that internally. We have looked at the returns, the past returns of private equity. We have used NPV. We have used different benchmarks. We have looked at the true fees, etc. And that's the situation. So that's not a very good deal. So at first, they tried to do co-investments with funds and direct programs, etc., to bypass the fees. It's working, okay, they say. But there are a number of problems with these strategies that my paper on this, the future of private markets, is available on SSRN. I'm going to upload a version tonight that is updated, but you can see the details there. I have to accelerate a bit. This I just wanted to show you because that's quite funny that now the S&P 500 is doing so well. You may notice that in presentations on private equity returns by practitioners, you don't see the S&P 500 anymore as a benchmark. It's the MSCI World. And the MSCI World has lagged the S&P 500 by 3% over the last 10 years. So people will put the MSCI World Index and say, look, it's still 3% outperformance. It's quite brilliant. So we can discuss that if you have some specific questions. But basically, the idea of like these asset owners of like going direct is that they can get a lot of the benefits that we've talked about earlier without having the problems with like misalignments of interest, high fees, and the like. So what happens is if you go directly buy buildings, roads, and so on as an asset owner, you can smooth your NAV as much as you want. You will have no problem with excess volatility. You even value it yourself. You hire your own auditor to say, what would be the value of all these buildings you have. So the smoothness of NAVs, you don't need to pay somebody 7% a year to have smooth NAVs. You can do that yourself very easily. The leverage, you can decide for yourself if you want subscription lines and all these things. You have a lot more control. You don't need to, you won't be front run by high frequency traders. You avoid all the costs of stock markets, etc. So all the rage right now for asset owners is, can I deploy capital directly in private markets, avoiding financial intermediaries or having some that aligns interest? Now, that's only the mega asset owners who think about that. Most of the average asset owners in the US and elsewhere are still thinking it's high returns in private equity. I give money to KKR and I will become rich. That's still like the mindset of most of the smaller guys. But the big guys don't think that way. They know better. They know everything I've shown here and agree with that. So all of the rage for them is, how do I deploy capital myself or via an intermediary I can trust? So in the US, there is an interesting initiative called PPC, which is ex-KKR people actually who started this. They have 12 state pension funds in the US, and it's a completely transparent structure where they are paid based on a budget that is set by the 12 limited partners that are state pension funds that sit on the board. So like the interests are like perfectly aligned. The management fee, the fixed fees are based on the budget. The way the carried interest also is calculated makes it a lot better, etc. So you have some initiatives in the US, you have some elsewhere on people trying to coordinate and to go to the markets directly and so on. So basically, I love private equity, but I'm a worried lover. I think the false claim on performance and its persistence has created a big problem on capital markets, that too much money went into an asset class, rising prices, rising fees, and misaligning interest because people had a carte blanche, because there was this strong belief that returns were amazing and shouldn't be questioned. And I'm afraid that this jeopardizes the PE model, because I think fundamentally it's a good model, but when people will wake up to the reality in 5, 10, 15 years' time, then people may just run away from that model and drop the baby with the bathwater. Some of what I said is also in this book, which is mainly structured as a textbook. There is a website, pelaidbear.com, where I'm trying to put a lot of resources for people who are doing research in private equity. So all my slides are there, my Excel spreadsheets are there, all the links to data sources, some data that I collected, like management service agreements, are all posted there. If you have suggestions or you have data that you're happy to share there, you can let me know and use that hub. On SSRN, you can read the piece on the future of private markets, and yeah, you have website, Twitter, etc. that you can use. Thank you very much. I think we have still a few times for questions. So how do we do the questions? Is that they're gonna show up? Yeah, you can do it. In the meantime, I want to thank again Karen and Eddie for coming all the way to here today and delivering two amazing presentations on papers that are early stage but highly promising, especially Eddie, who flew all the way from Boston just for us. So thank you very much again for great presentations. So why does your sample stop in 2009, Eddie? What did you cook?
Nothing surprising. Is this on?
Yeah, it's on. And speak very closely.
Yeah. The main reason was we wanted to have 5 years post, so that already put us within a few years of the current, and then that just takes us a while to work on the project. So we may get a couple more years out of it, but with a 5-year horizon. I mean, one of the things that we're seeing is that these are exited a lot slower than the public to private transactions. So,
but it could be the time period as well. Like in the recent period, the holding period has gone up a lot. So that's yeah.
That's okay. Is there any statistics showing that now?
Yeah, Preqin would publish with like average holding period stats, and it has gone like we're close to 6 now, and like 5.5, something like that. You have it also in the Bain Company report. So if you go to my website, pelaidbear.com, there is a link to like the Bain Capital annual report on private equity. They will always plot like the holding period per vintage. And it's not too bad to stop like in 2008, 2009 in when you do these sorts of studies, because the number of deals have kind of gone down right after that. So it gives you like a natural stopping date in order to have enough time, and then you don't miss too many observations, because then they reappeared, but then they are very recent. So it's a point. Anything else? Otherwise, you can shout the question, and I can try to repeat it if you don't want to type it.
So, can I ask you a question?
Okay.
I mean, you started saying, you showed us these tables of the mega asset owners, the Norwegian Pension Fund Global being one of them. But you never really concluded with should they go beyond the public markets to get sufficient diversification?
Yeah, it's because I think we don't quite know the cost of their model, right? Because so it does feel a bit crazy that they hold 12,000 stocks, right? The cost of that is massive, right? How do you handle like 12,000 positions? And now that they increased the fraction of equity following your report, and their fund is still growing, like at one point they're going to run out of stocks or something, right? So what we don't know is like what transaction costs they are facing by deploying so much money in listed markets, right? So it feels, and intuitively would feel like if you have that much money, and we know, well, the old studies would say beyond 30 stocks you're diversified, right? So let's just put that number at 100. Technically then what you should do is that you buy 100 different assets all around the world and you just buy and hold these things, that's it. And that's probably would be like most cost efficient, best diversified approach. But then you come to like the governance of that. How do you like mandate someone to just like buy 100 things? But intuitively, I can see some merits from there when they complain about that the listed markets is a big challenge for them as the Norwegian sovereign wealth funds. I think that the issue is, in the current conditions, if they go via funds, which was what the report recommended, like if you go via the KKR and the like, it feels very wild because the interests are not aligned. You have these massive fees and so uncertain returns, but certain large fees. And so the report then just said, you know, it's okay because you're large, so you will not pay that kind of numbers. Well, I don't know. Everybody else does, so. So that's my yeah. In current conditions, it would be very tricky to go in private markets because of the intermediaries and the way they organize and all the buzz around them. But going forward, I can see the underlying argument. I think it makes a lot of sense. But I mean, in that piece, I speculate a bit. You could imagine that there is no public markets in like what the Jensen prediction happens. There is no public markets anymore, and you just have some auction-based private markets with large asset owners. So you would have like 100 large asset owners. There is an auction like every week where they can slightly rebalance their portfolio, and they just directly own assets and change some stakes in them as they need to from time to time, just having an auction. So it's not clear we need public markets. These guys clearly do not need them. So at one point, I think it would just be one giant private market with 100 guys just trading with one another. So that's one speculation. And then public markets will be a sideshow. Thank you very much. Thank you for attending. Ciao.